Welcome to the REI Diamond Interview, your source for real estate investment jewels of wisdom with Dan Breslin.
Welcome to the REI Diamonds episode number 31 with Joe Fairless on buying multifamily apartment complexes in emerging markets. I'm Dan Breslin, and on these REI Diamonds podcast interviews, I invite world-class guests to share their valuable experience as it relates to real estate investing. In short, the information you're about to hear can make you money. Today's episode guest is Joe Fairless, who runs the Best Real Estate Advice Ever podcast and Joe Fairless Investing. Joe has an interesting story here. Joe actually controls, the Joe Fairless Investment Company actually controls over $21 million worth of real estate. And this was all put together, at least from my perspective, in a very short period of time since 2012. Joe, welcome to the show.
Yeah, thanks a lot for having me. I'm looking forward to our conversation.
Appreciate you coming on and giving of your time and your knowledge. So, let's give the listeners a brief background, not all the way back to the womb, but certainly how you got your start, what you did pre-real estate, and how you kind of made the transition to where you're at now.
Sure. So I graduated in 2005 from Texas Tech University. My major was advertising, and I moved straight from Texas Tech, so Lubbock, Texas, to New York City. Complete change of culture and pace from cows and cotton to skyscrapers and concrete. And I was making probably, when you factor in the hours, less than minimum wage. I was making $30,000 living in New York City as a junior project manager, working on Madison Avenue at an ad agency. Then I eventually had $1,000 to invest once I scraped my pennies together about 2 years later. And I didn't know anything about investing, but I was walking by my bank and I saw in the window that they had something called a CD. I didn't even know what a CD was, certificate of deposit. And they had an interest rate that was, I want to say, like 1.2%. I don't remember the exact percentage, but I knew that was more than I was making in my savings and checking account. So I ended up putting my only $1,000 in that CD, and 12 very, very, very long months after that, I got my money back after they'd been holding it hostage for 12 months, and I got a whopping $18 profit from that 12-month
wow.
period. And then they took taxes out of that $18. So I was like, what the hell? There's got to be a better way. So I just started reading a whole lot. The first book I read was Investing for Dummies, and they talk about the three different types of investing. One, stock bonds. Two is LLC, so startups. And then three is real estate. I gravitated towards real estate because probably my family background, and also my sister is a real estate agent in the Dallas-Fort Worth area. Then I just kept reading more books, read Rich Dad Poor Dad, and that's whenever the light came on in my mind. I was like, okay, this is something that I want to do. And I told my friend at the time in 2006 that I was going to buy a house. I was going to buy an investment property, and I'm still friends with her. She lives in New York City, and she'll tell my friends that to this day. Well, I remember back whenever he had this idea of buying a house. I didn't have the money, though, at that time to buy a house because I still wasn't making much money in advertising. But as I was progressing in advertising, I kept making more and more money. Eventually, I was the youngest vice president of a New York City advertising agency. Base salary was $150,000, not including bonus. So I climbed and that was before my 30th birthday. So I climbed the ladder relatively quickly. And as I was climbing the ladder, I started looking at investment property. And my first purchase was a 4-bedroom, 2-bath house in Dallas, Texas in 2009. And that was just a stroke of luck that I bought in 2009. I'd like to say that I was seeing the bubble happen, and I chose to be on the sidelines, but that's not the case at all. I didn't know what the hell I was doing, really. I just didn't have any money to invest until 2009. And I was just luckily, timed it right, or the timing was right, rather. I didn't time it right. I bought a house for $76,000, 4-bedroom, 2-bath, like I mentioned, and it's rented for $1,100, $1,095, almost $1,100. And that was my first purchase, and that's how I got going.
Nice. And what did the financing structure look like on that first deal?
It was just standard. It was 20% down, all in. I believe it was $20,000 all in out of pocket when you factor in the down payment plus the closing costs plus the inspection and stuff. I remember the figure of $20,000 that was no longer in my bank account.
So $20,000, your mortgage and the taxes and all that must have been what, $750, $800 a month by the time all that was calculated?
Yeah, I think that's a fair number. Yep.
It's probably
I don't remember
$300-400 a month.
exactly, but yeah, somewhere around there.
So I'm wondering, do you still own this deal, this house in Dallas?
I do, yep. I still own that house. It's in Duncanville, Texas, which is south of Dallas, about 15 minutes. It's in an area that hasn't improved, and it's, I'd say, slightly gone the other direction, but just slightly, because whenever I was first finding a resident for that, it was a family, but now it's kind of Section 8, which this is the first time I've ever rented the Section 8, just this past summer. And it's been a good experience. I'm actually getting, I think I'm getting $1,200 a month for that house now. Maybe $1,250 for that house now that I was, getting $1,100 before. And because it's, at least what I've seen is I get a premium for Section 8 tenants. So
let's talk about, because I know where the transition's going to go. So you bought one, and then the plan was buy a second, and let's talk about how many you made it up to, and then what shift in your thinking happened, because this is an interesting story right here. So you know where I'm trying to direct you to go.
Yeah. You know the end of the story, so it's all right, how did you get to that point? It's an interesting, as a side note, it's an interesting game. I just got done teaching a week-long class at Texas Tech University, and one of the games we played is I gave them the last sentence of a story that they had to come up with, and they had 3 minutes to come up with this minute-long story, and one of the stories was one of the sentences was, and that's why the hippopotamus left the room, and so they have to reverse engineer the story. It's actually a really fun game for a dinner party or something. But after that first house, I got another house. So I bought the first one in October of 2009. The second house I got in April of 2011. That one was 10% down, where it's actually my favorite purchase. $81,000 purchase price, 10% down, so $8,100. I got it through a program called HomePath, which you may or may not be familiar with. It no longer exists for investors, from what I've been told, but it allowed me to put down only 10% for an investment property, which is amazing. And
wow,
I ended up buying that all in about $12,000. In the home today, the thing about the first home, the 4-bedroom, 2-bath, I bought it in 2009. It's probably worth $120 now, based on the estimates that I've been receiving. And with this $81,000 house, it's probably worth $130 now, at least, I'd say, because it was built in 2006. I didn't mention the first one. The first one was built in 1996. This one, the 3-bedroom, was built in 2006. A really nice house. Rents for $1,200, and I might be getting my rents mixed up because I really haven't looked at it in a little while, but it certainly cash flows a couple $100 a month. Then the third house I got was about a year after that, so we'll say April of 2012. That was a purchase price of $65,000. I actually paid all cash for that one. $56,000 of it was my own money, and then the difference was a 0% interest advance on a credit card, and then I simply did a cash out refinance on that property, and it appraised for $86,000. So all in, I was at $65,000 cash, and it appraised for $86,000. Then because it appraised fixed loan to value, 25%, I was able to actually get all of my money back out. So I literally have none of my money into this third house that I own, and it cash flows a couple $100. And then the fourth house I bought a couple months after that, so we'll say the summer of 2012. I bought it with a personal line of credit for the $40,000, which was a 7% interest rate. And that was the ugly duckling of the bunch, and I no longer have that one. I sold it. It was built in 1960-something. It's a 2-bedroom, and it just wasn't I wasn't digging it. I went away from my model with my other homes. I bought it from a wholesaler. Then the wholesaler said that I needed about $5,000 worth of repairs. And remember, I'm in New York City at the time, and I'm buying in Dallas-Fort Worth, where I'm from, but nonetheless, it's 1,000 miles away. So I was like, okay, $5,000. Well, it cost me about $15,000, and part of it was me not having a good construction crew, and part of it was me just not doing the right due diligence on it. So all in, I was probably at about $55,000, and ended up just getting rid of that one. Then where the transition happened, and this is kind of the ending you were alluding to where I'm at now, I was just unfulfilled with what I was doing in advertising, and life's too short to do stuff you're not fulfilled, or life's too short to do stuff you don't care about, I think. And I'm a huge Tony Robbins fan, and he talks about the 6 human needs, and I won't go into all 6 of them, but the last 2 lead to fulfillment, growth, and contribution. And I wasn't growing. I didn't feel like I was learning, mentally stimulated in advertising anymore. I'd reached my goal of being a vice president, making the money I wanted to make, but I just didn't care about it anymore. And I also didn't feel like what I was doing mattered. I didn't feel like I was contributing to anything meaningful. So I started sampling different life experiences. I did stand-up comedy. I'm not a funny person, by the way, so people usually say, well, tell me a joke. So I did stand-up comedy for a little bit. I will say that I've performed at 2 comedy clubs, and one of them in New York City is now shut down. So if that gives you an idea of how good I am at stand-up comedy.
All right.
And then the other thing I did, I was teaching classes in New York City on how to invest in other markets that cash flow while living in New York City, talking about my personal story. And I was also writing a book, which I have basically everything there. I did like 60 interviews with remarkable people in marketing, advertising, and just their careers. And I was going to write a book on how to have a remarkable career. So that will eventually get completed. So I was really unsettled, and I was doing a lot of different stuff. Eventually what I realized is I just want to get out of this advertising thing. And I wrote an email to my family in November of 2012. I still have that email. And it said, I came, I conquered, now I don't care about advertising at all anymore. I'm leaving. And that's what I did. I ended up, that was November. In December, the agency I was working at, I said I was leaving at the beginning of 2013. In December of 2012, the agency I was working at lost half their clients, and they ended up laying me off. And it was, I was definitely the happiest person that anybody, for anyone who's ever been laid off, because I got like these benefits for being laid off, and it was a much smoother transition into the entrepreneurial world. And what I did is I used the money from the cash out refinance on my third house I was mentioning as money, seed money essentially, to start my own company. So I had about $50,000 to start my own company for that. And then my first venture was actually I wanted to be a career consultant and help young professionals in advertising, marketing, PR do well and climb the corporate ladder. I hired a designer and developer, paid him $3,000, had a website, and then realized I didn't have any clients. There's a flaw in the business model because I had a product, but I didn't have clients. And that's whenever you got a problem with the business. And what I realized, and this is where we get into the apartment stuff that I do now, I started talking to more and more people about my homes. And they're like, well, if you do something larger, let me know. I heard that from like 3 or 4 people. And it just hit me. I was like, wait a second. I think I have a client before I even have a product. And that's when you know you got a good business, when you have your customers before you actually have the service or product. And that's what I did. This was February of 2013. I started looking, and I'd been studying multifamily for about 4 months. And I ended up closing on my first place, 168 units in Cincinnati, February, March, April, May, June, July, 6 months later. Basically what I do now and what I did there is I buy apartment communities with investors, and we're sharing the profits.
So you made this shift. What I'm wondering, you have no other single family houses beside those 4, right?
That's correct.
and you consciously made this decision. This is like kind of mind-boggling, and you are seeming to be, the kind of guy that sees the moon and has to shoot for the moon. Hopefully, if you miss, you're still amongst the stars. You're definitely setting the goals high. VP, climbing the ladder in the corporate world. It's pretty interesting that you weren't forced to make that decision on your own, but like the universe helped make that decision and transition for you by kind of bumping you out. That was a pretty cool little piece of serendipity. But did you sit down and make this conscious decision to, strictly make the shift right into apartment units, or was that just kind of trying a few different things? And I made the conscious decision to go into apartments because I saw my homes, and at first, whenever I created my 10-year plan, it was to buy, 50 homes, and they're all cash flowing at $100, $150, $200 a month. I was like, this is I bought 4, and I was like, there's no way in hell am I going to do this. It's too much damn paperwork. It's too much of a headache to manage. It's just too much minutia that I don't want to get into. So at that point, I started studying multifamily, and I read the book. I read the book, Commercial Real Estate, Investing for Dummies. I've read, not every book, but I've read a lot of books on multifamily investing. I never considered industrial, office, retail, storage unit. I just naturally gravitated towards multifamily. And so it was a conscious decision to essentially buy multiple homes at once. That's how I was looking at it, and I just wanted to figure out how to underwrite it and how to be educated on how to do it. All right, so let's talk about the structure of that first deal and kind of some of the steps that you took going into it. Specifically the style, structure of the offering. How much money did you have to raise? What kind of management did you have in place, or did you plan on putting in place from the beginning, and kind of all the challenges that came along with getting that deal, from how you found that deal, put it under contract, to the point where you're at now? I assume the rents are coming in and it's on semi-autopilot for you in your portfolio right now. So can we just kind of walk through that entire first 168-unit deal, Joe? Yeah. Help me answer it. So what question do you want? Those are a lot of questions. It's a multifaceted. What I'm looking for is a 3 or a 4 day seminar compacted into about 17 minutes here for the listeners. We'll start with how did you find the deal, and what did the negotiation feel like? What were some of the challenges there? Found the deal through a consultant that I had hired. He was actually just someone I'd seen around, and I got to know him a little bit, and made sense for me to hire him and help me learn the business and how to raise money. And as far as the negotiations, we actually got it through a creative strategy. We got it through a master lease, and the reason why we did a master lease is because there's a large prepayment penalty on the property of about $1 million, and there's no way to really move the property from the seller's standpoint unless they were able to do something creative. And for anyone not familiar with the master lease, basically it's where we take over all of the income, but we have to also pay the expenses, and we have to pay the mortgage. Now the benefit of doing that is we also receive the principal pay down on the mortgage. So every month, with this mortgage in particular, every month we build $15,000 worth of equity in the deal. So time is on our side. Now we have the master lease for 4 years, so from July 2013 to August of 2017, and we can exercise our option to purchase at any point in time. Now, the disadvantage is we really can't sell at the early years, the first couple of years, because the prepayment penalty is so high, or we can't refinance and enjoy these nice low interest rates. But once the prepayment penalty burns off a little bit, which it is right now, it's at around $450,000, so it's split in half at this point. Then you can start looking at the analysis of, does it make more sense to eat the prepayment penalty and put new debt on it with the low interest rates than keep the 6.19% interest rate and not trigger the prepayment penalty? Interesting. So you needed $1 million in capital for this first deal, Joe?
Yeah, I needed 1.3 for the first one. I did not know I needed 1.3. It's likely I would have never have pursued it if I had known I would have needed 1.3 million, because at the time I thought I could raise $250,000 because it was coming from three sources. I thought between those three I could raise 250. And again, I'd never raised a penny before in my life. I was working in advertising. So the deal initially, as it was presented to me, I needed to raise about $400,000, and I was like, okay, I can do this. Then things changed. I don't exactly remember the details, but things changed where eventually I needed to raise 1.3 million. And so how we structured it is, I raised about $1 million, and then the deposits and the prorated taxes. So the deposits were credited towards our down payment for all the units, which was I think like $50,000, and then prorated taxes were credited. And then on top of that, the brokers who were in the deal, they actually reinvested their commission into the deal to be 25% owners. So we had to I could bring less to the table from our end and still close on it with majority of the ownership, which my group has 75%. So it took a lot of kind of creative structures to make it happen, and it was certainly an ever-evolving business structure until the very end whenever we signed the contracts. But it was, it was a way to get in on your first deal with I didn't even talk about this. I didn't put any of my own money into the deal. Initially, I didn't put any of my money in it. I received that closing a $22,000 or $23,000 acquisition fee, and then I have almost 13% ownership in the deal.
What did that money go toward in the deal, and how is it secured to the property or to the LLC? I mean, what kind of documentation do you use for that?
As far as the contract that wrote up?
Well, you raised $1 million, $1.1 million. I mean, that had to go either toward construction or maybe an option fee, or you kind of bought the old owner.
Yeah, that went to the option fee.
Option fee, cool.
Yeah.
And then how did you secure that to the investment itself for the lenders? You can't really put a mortgage on something.
No, it's just we have the option to purchase, so we control the property at any point in time. Now, the only way the sky falls and we really mess up is if we don't exercise our option to purchase and the master lease expires, or we don't sell and the master lease expires. At that point, we're out $1.3 million, but obviously that would never take place because we're going to either exercise our option to purchase, or we're going to assign the right to the property to purchase to someone else, which is actually happening right now. 2.5 years later, we're about to be under contract to sell the property and then reinvest those investor dollars into the next property that we're working on.
So you're getting rid of this first deal?
Yep.
Let's talk about Cincinnati. I know that emerging markets are kind of your thing. So what were a few of the parameters as to why you guys chose this first investment? And it sounds like it's a successful one at this point. Maybe how those parameters work in your favor.
Yeah, it's really simple. Whenever I look at a market, it's about jobs and job diversity, and then population and population growth. I mean, it boils down to that. There's so many subsets of each of those points. For example, supply and demand and absorption rates, and how many new builds are coming online. But it just boils down to common sense, and that is to have people pay you rent, they have to have a job, and you want to hedge your bet on the different sources of jobs for the tenants. So specifically what interests me in Cincinnati is 9 Fortune 500 companies are headquartered here, from Macy's to Procter & Gamble to AK Steel to Kroger. I mean, those are very diverse type of industries, and that's what really was the selling point for me and for the investors. You're not going to get rich quick here, but slow and steady wins the race in Cincinnati, and that's what I like about it, especially if you're buying in a submarket that is growing, which is what we did. I didn't mention this, but a mile down the road from our property, there's the second largest Kroger marketplace. Now, I guess now it's the third largest Kroger marketplace in all of Ohio. And that was built about a month after we closed on the property. So we're in the path of progress. As far as Cincinnati goes, macro level, it's got the employment base, and the population growth has pretty much remained flat, but they have a Chamber of Commerce that is incredibly active, and the strategy is smart. They're actually focused on growing the current Fortune 500 companies they have. They're not as active in acquiring new Fortune 500 companies because they don't need to. They just want to help the current ones grow and have more of a presence here, and I like that approach.
Do you take into consideration like the business tax environment and the general political view toward business and cooperation or against business? Sounds like you may have considered some of that.
Yeah, I think that ties into the Chamber of Commerce and what type of environment they promote. I'd also say that I do always look at if it's a landlord-friendly state. You know, New York is terrible for landlords. New Jersey's terrible for landlords. Ohio is good to be a landlord. Texas, if you squat in a house in Texas, they'll chase you out with a shotgun. So
nice.
those are states that I like investing in, and that's how I determine. I mean, that's my litmus test of is it landlord friendly or not. How long can someone squat in your property without paying rent? In New York City, you can squat in an apartment without paying rent for 6 months. 6 months is how long it takes. And let's think about that. After 6 months, are they going to leave the property nice and pristine? You know, they're going to leave it in disarray. It's all about how quickly can you kick people out if they're not paying you, and that's one of the other reasons why I like Ohio in general.
When you guys bought this building, was it just the option fee? I know you had mentioned that $400,000 is initially what you thought. What happened? What challenge? What switch took place that required you to bring so much more capital to the deal?
I don't remember that part. I think it was that the brokers said that to me, and they just were mistaken or misinformed or did not tell the truth. One of those, but somehow it grew from $400,000 to needing to bring more money in the deal. So I don't exactly remember the details though.
Got it. And then did you guys do any repositioning at all? Raise rents? Any construction? Any physical changes to the property itself?
Yeah, we did some, I'd say, light repositioning. We didn't do unit upgrades, but what we did do is we completely cleaned out the current tenant base there. I'd say about 90% of the people living there just weren't paying, some were paying rent, but albeit late. Well, most of them just weren't the type of characters you want to be living next to. And that was a key learning. I learned the hard way the difference between physical occupancy and economic occupancy. Physical occupancy is what I was focused on, incorrectly focused on, where they said, well, we're at 97% occupancy, and I thought that was great. Well, who gives a shit? It's about economic occupancy and how many people are actually paying for them to stay in the place. So the first couple months were eye-opening for me, and I realized that the people who were living there weren't the best. So we did a major overhaul, and now we have people who have been screened properly, and they have slightly better paying jobs, and they're not criminals. That's the most important part. There's a lot of police officers being called to the property initially, but now we actually receive compliments from fire department and police officers on the work that we've done over the course of the last 2.5 years, which is nice. So that was the major thing, just putting in the right people and making sure that they're paying, and then just enjoying the principal pay down on the mortgage and building equity that way.
Joe, how often or how involved are you physically? Do you have to visit this property often? Are you an on-site manager, or did you simply develop some systems and put some people in place to do this transition with the tenants?
A combination of all of them, with the exception of me being on-site managing. We've always had a community manager there, but I have been more involved than I anticipated being involved. But the management company has always had a property manager, a maintenance person or two. We have someone who cleans up the trash around the property. My main responsibility is just making sure our business plan's implemented, and that it's my number one responsibility is paying my investors, and by doing that, the property is performing. So that's been my main focus. And we closed on a 250 unit in August, so 4 months ago, and that's also the same type of approach I'm taking there as far as the asset management approach, where really do a lot of legwork at the beginning. Then over the course of the hold period, it's having some checks in place and milestones for the management company, holding them accountable, and overseeing the P&L statements on a regular basis, and then keeping the investors updated.
Interesting. So let's talk about the investors. Initially, you thought you could raise $250,000, and all said and done, you raised 4 to 5 times that amount. How did you overcome that challenge, Joe?
A lot of crying in the corner late at night. Yeah, it was challenging to get the investors on that first deal because, like you said, I thought I could raise $250,000, but I need to raise a lot more. The investors came from, just life, from my life experiences. I have 12 investors in that first deal. I have 12 investors in the 250 unit deal on my side. And on the first deal, it was people who have known me in advertising as an advertising professional, someone who's on my flag football team. I was the captain of our flag football team. That's the only way he knows me is through flag football. 2 people who, one person I went only to college with. I was his roommate. Another person I've known since middle school, and we went to college together, high school, college together. I'm on the alumni advisory board for Texas Tech. I have 2 investors from the board. So really just different areas of life. And one tip I'll give your listeners if they're looking to raise money is to create a spreadsheet, and in the spreadsheet write down, in one column write down their name, or just put name column. Then the next column put amount low and amount high. Then the next column put network. And what you want to do is you want to list how you know them from each of the networks that you're a part of. And the goal is to get one person from each network to say, yes, I'm interested. And then what you do, assuming they're cool with this, you name check that person when you make the next introduction to someone they know. That way, it's a group kind of herd mentality. One of my biggest investors said to me, I remember this clear as day, he's like, well, if so-and-so is investing, then I know that he's really smart with his money, then I'll go ahead and invest. And this person ended up being my largest investor. He certainly did his due diligence, but it lowered the barrier to entry by having his friend who he respected in the deal already, and it made our conversation go a lot easier. So that's really the goal as you're starting out and raising money.
Interesting. Some validation. That's a great method there. Let's talk about the offering. What was required for you to, I don't want to call them promises because I don't know if you get in trouble for that, but, what was the offer for the investors? Yeah,
the structure is 8% preferred return and an equity split above that 50-50. And then until they get their money back, then there's a hurdle of 70-30 after that.
You're getting 70 or they're getting 30?
I get 70, they get 30.
So
after they receive their money back.
You were getting 13% of the deal, right?
Mm-hmm.
And the brokers got 25% of the deal?
Yes.
And then did you basically have the remaining portion of ownership in the deal go to the investors?
Yes.
Now, as far as finding deals, sourcing deals, you came from an advertising background, Joe. Can you describe for me how you were able to kind of leverage that experience and that knowledge that you had gained in the first half of your career and apply that to what you're doing now? Can you give us a few examples?
Yeah, it's interesting. I was just at Texas Tech, like I mentioned earlier, and I was listening to the dean talk. He's the dean of the College of Media and Communication. He said that our major is the only major that can be incorporated into pretty much anything out there. if you think about maybe chemistry, then that can too, because it's just like the compounds and stuff. But just practically speaking, media and communication, you apply those skills to any type of profession. How I use my advertising skills is, just knowing certain things like word of mouth drives sales more so than anything else out there, period. You can come up with the cleverest TV spot or ad, but if you have good word of mouth and you know how to facilitate word of mouth, then that's going to be your number one best sales tool. So I constantly focus on coming up with ways to make the word of mouth happen. One of them is having the podcast, because I'm able to have wonderful guests. I mean, you were on the show on my podcast, and by having guests like you on the show, I'm able to have listeners who love the interview, and then they share it with others. And while I might not be center stage because I'm interviewing a guest, I'm still present, and they build a relationship with me even though I'm not directly having that one-on-one conversation with them. And that's been really important, and the podcast has been a game changer for me professionally.
Interesting. And about how long have you been doing the podcast, Joe?
1 year and 2 months. It's been a daily podcast.
Every day, huh?
Yep, every day.
Rigorous schedule.
Yeah. I have a good team in place. Whenever I started, I was doing everything from finding the guests, interviewing the guests, editing the episode, which I taught myself editing program called Audacity. I hated it every second of doing it, but I did it for 2 months. It took me 2.5, 3 hours to edit one episode. Then I would publish it. Then I would edit it on my blog. Then I would promote it in social media, and I would send an email to the guests. It gives me a headache just thinking about everything I was having to do. And what I did is I gave myself a 2-month window of time to see if it was a good use of my time or not. So if this was October, and I said, all right, I'm going to do it daily. Actually, I guess it's 3 months. I'm going to do it daily. And by the end of the year, I'm going to take a step back. I'm going to see if it's a good use of my time. And in December, I got my first sponsor, $2,500. They sponsored a month for January. And then I just saw the different type of exposure I could get from having a podcast. And I enjoyed it. I'm learning a whole lot every day. And for all those reasons, I continue to do it. Now, all I do is do the interview. I find some guests on my own, people I come across, but primarily I just do the interview, and I've got team members who do all those other things I mentioned.
Yeah, that's interesting. So I started my podcast maybe 4 or 5 months ago, and it actually began as a newsletter, and I was sitting down and I'd crank out like a 4 or 5 page newsletter. I would update the website, build the graphics, take the pictures, and also include the podcast. And, that just became way too much work for me in the midst of running my team and my full-time business. But one of the greatest things, and I'm sure you can relate to this, is to get to talk with people like yourself, the variety of guests that come on the show, and hear everybody's perspective on what they're doing in the business. And I'm sure that all of our listeners don't identify with every single one of our shows, but there's definitely, topics that I know I present. I've, listened on yours as well, that you present a variety of topics that are pertinent, for many different people in the business. And it's such a great place to be able to spend time examining the thought processes,
I love it. Yep, agreed.
Well, cool. We're kind of wrapping up here, getting towards the end. Do you have any book recommendations for our listeners, Joe?
Well, it just depends on what they're wanting to do. I'd say for a baseline, Crucial Conversations is a book I recommend to pretty much anyone, because we all come across conflict in our lives, whether it's in personal relationships or business relationships. And the book outlines how to approach conversations whenever the stakes are high and opinions vary. And I'll give you a spoiler alert. The thing that they say is to establish a mutual purpose. If you peel back the layers of the conversation and what you two are not agreeing on, you eventually can get, for most of the time, you can get to a mutual purpose that you both have. And then you start building up from there versus trying to, go left and right on certain points. Just build up from the center of the mutual purpose. So Crucial Conversations is a book I've read like 3-4 times. Another book I really like is The 48 Laws of Power. It's great for entrepreneurs. From a historical standpoint, they talk about how people have attained power, some good ways, some unethical ways, but it's just truth. And you decide what you want to do with it. And then for real estate, one of my favorite apartment books is called The Complete Guide to Buying and Selling Apartments by Steve Burgess. As the book would indicate, it's a pretty comprehensive book, and it's easy to read and learn a lot of good stuff.
Bear with me, I'm taking notes here. Crucial Conversations, do you happen to know the author, Joe?
It's a couple authors. If you Google Crucial Conversations book, it'll come up.
And then I think it's Robert Greene that did the 48 Laws of Power, and you mentioned the author.
Yeah. And the author for Crucial Conversations is Joseph Grenny, Grenny, Carrie Patterson, and Ron McMillan.
Cool. So I have one other question. I'd like you to answer this two ways, and that is one for the investor who might be just getting started, and then two for the seasoned investor. And that question is, Joe, do you have any final jewels of wisdom to share with our listeners?
Oh, I'd say the most common question I get is, how do I get started? And I'd say the best way to get started is to become educated first. So read all the books, listen to podcasts like yours and mine, and reach out to people who are on those podcasts or are authors of those books. Learn more. Then do as much as you can without hiring a consultant. I'm a fan of consultants, but I also think there's benefit to making things happen on your own. Then when you hit a roadblock, bring on consultants, whether you pay them or whether you have some sort of other agreement, because you'll want to have someone who's been there, done that, learn from them and then just model your behavior or your approach after theirs and get similar results. That's what I do. I mean, with raising money and buying apartments, it's not a groundbreaking business model. It's tried and true. People have done it before me. So I'm simply doing a business model others have done, but just adding a little bit of a unique flavor to it with my own background and how I approach it.
Cool. And when you say consultants, do you are you using that word interchangeably as mentors that people see in the market, or is that specifically something different that you're kind of referring to?
Interchangeably.
Cool. Joe, how can people get more information about you and what you're up to?
You can just Google my name, Joe Fairless, and you'll find my website. It's joefairless.com. You'll find my podcast, other interviews probably that I've done. I've done a good number of interviews, and you just check out all that stuff. I'd say the two beneficial things, if I was listening to beneficial things that I would do after this would be, one, subscribe to my podcast because it's a daily podcast. I don't think anybody out there is crazy enough in real estate to be doing a daily one, at least not as long as I've been doing it. Number two, and I've interviewed Robert Kiyosaki, Barbara Corcoran. Tom Wheelwright was a really interesting interview. He's a Robert Kiyosaki CPA. He talks about 1031 exchanges and some surprising things. And then two is on my website, I've got a free real estate investing crash course, just a video course, and you can grab that too.
Well, Joe, thank you for coming on the show and giving of your knowledge. I really appreciate your time and wisdom.
My pleasure. Thank you so much for having this conversation, and looking forward to staying in touch. And thanks, everyone.
Sounds good, Joe. And thank you all for listening to this episode of the REI Diamonds podcast. Are you enjoying what you hear here? Maybe you know somebody else who'd also enjoy this episode. The best compliment you could give me is a referral, and you may be doing the referral a big favor by sending this over to them. You can also sign up to receive email updates of new weekly interviews at www.reidiamonds.com, and I'll also send my special report called 7 Sources of Off-Market Deals. Again, that website is www.reidiamonds.com. And you can also subscribe in the iTunes app. Search REI Diamonds, click subscribe. Until next time, this is Dan Breslin signing off.
Thanks for listening to the REI Diamond Interview. To receive the REI Diamonds newsletter and interview monthly, sign up now at www.reidiamonds.com.